You spot it, the perfect entry at a rock-solid support level. You place your trade, set your stop loss, and wait. Then the price dips. It drops just far enough to hit your exact stop loss, closing you out of the trade right before it immediately skyrockets in the precise direction you predicted. Many traders see this as bad luck, or assume their broker is maliciously rigging the feed against them, but the timing of that reversal is rarely an accident. This specific sequence is a visible symptom of institutional liquidity, a mechanical design used to move massive sums of money. Most beginners are taught that Forex is simply about exchanging currencies based on visual trends. They trade geometric patterns and arbitrary support lines, unaware of the actual volume of orders driving the price behind the scenes. The financial institutions moving the market do not trade based on retail chart patterns. They move toward areas where they can find liquidity. To survive in this market, you have to peel back the candlesticks. You have to stop looking at a drawing board and start reading the chart as a map of institutional intent. At the pyramid's absolute top sit central banks and Tier 1 investment banks, dictating global capital flows. The middle tier holds brokers and aggregators, hedging risk by routing orders upward. At the bottom, retail traders represent microscopic volume, fueling the massive transactions happening above. The reality of this ecosystem is that the entities at the top rely on the thousands of small positions at the bottom to provide the raw fuel necessary for their market maneuvers. Imagine a Tier 1 bank needs to execute a $500 million buy order. If they simply buy at the current price, they will instantly inflate that price against themselves. To fill a position of that size, they are bound by the law of liquidity. They must find a massive concentration of sellers at one specific price point to match their buy order. This diagram illustrates exactly where they find it. A cluster of retail stop losses just below a common support line provides the exact concentrated sell orders the bank needs. The market price is pushed down, triggers those stops, absorbs the liquidity, and sharply reverses upward. The institutions aren't tracking individual retail accounts. They are simply executing mathematical strikes on areas of high liquidity. You can navigate this ecosystem by controlling 3 specific variables. The first is asset selection. Professionals focus on high-volume majors, avoiding low-volume exotics. Exotic pairs carry structural risks. In volatile conditions, their prices can gap from one level to another, bypassing your stop loss and multiplying your intended risk. The second variable you control is timing. The optimal trading window is the golden hours, the 4-hour overlap when both the London and New York sessions are active. This overlap offers the deepest liquidity in the market. During the dead zones of the Asia session, volume drops, and institutions often create sideways accumulation traps to catch impatient traders. The third and final variable is execution. Relying on market orders, buying at whatever the current price is, often leads to slippage in a fast-moving environment. Professionals use limit orders. This allows them to dictate their exact entry price, neutralizing the costs of execution lag. Mastering your asset selection, your session timing, and your execution limits helps you avoid being swept up in institutional momentum. Even with perfect timing, the final mechanism for survival is risk management. Without it, the high volatility of 2024 will eventually deplete an account. This graphic breaks down the professional 1% rule. On a $10,000 balance, exactly 1%, or $100, is isolated to equal a highly controlled monetary loss over a specific distance, like 20 pips. Ignoring this math leads to the trap of random reinforcement. Winning a reckless trade without a stop loss tricks the brain into abandoning strategy for luck, a habit that guarantees failure when the market eventually moves against you. With strict mathematical rules and a positive risk-to-reward ratio, an institutional trader only needs to be right 30 to 40% of the time to maintain a profitable portfolio. Moving forward, the goal is to view price action as a constant search for liquidity. It is about recognizing the intent behind the moves, rather than guessing at patterns. Aligning with the smart money requires stepping out of retail constraints and executing your trades with institutional-grade technology. FXNX provides exactly that environment. The platform offers 0.0 pip spreads, exact limit order execution, and integrated NX AI analysis to help you identify true order flow. You can trade with precision and intent, or you can remain the liquidity for someone else. Open an FXNX demo account today and download the FXNX Institutional Liquidity Checklist to audit your strategy.